Hi, everyone. This is Jason Burack of Wall Street for Main Street and independent financial journalist Eric Dubin. Welcome back to another Welcome to Dystopia podcast. This is episode number 37. Are you feeling a lot better, Eric, from your vacation?
Well rested and still trying to catch up with markets, but yeah, it's nice to have a break. And gee, a couple of silver flash crashes and a flash crash for gold, and lots of fireworks going on. So I guess you can blame me for taking a vacation. I caused it.
I'm not blaming you because, the gold and silver markets are acting kind of weird. We have the dollar index near 30-month lows, yet gold and silver are struggling gold is struggling to stay above 1250 and silver is struggling to stay above 16. The dollar index in early January 2017 was at 103, around 103, and now, here at the end of July, it's barely above 93. Enormous move down in the dollar index. Normally, Eric, with correlations, that's normally good for gold and silver. But, last week, gold was barely able to stay above 1215, and thankfully, we've had a little rally.
Yeah, correlations like that would have put gold around 1400 or what have you, based on typical historic trends and whatnot. So the main factors behind why gold is where it is has been primarily twofold. I mean, the manipulation is something that we've spoken about ad nauseum, but there's also that psychological impact of the fear of the Federal Reserve normalizing balance sheet and the ECB doing the same. And they've been issuing this propaganda almost as far back as, 2010's Bernanke's green shoots idea, where, the economy is going to do better than most people believe, so don't worry, we're not going to shovel endless credit into the marketplace. And here we are, 2017, living a world where central bankers have been dumping $150 billion of credit into the marketplace on a monthly basis, and then at the same time talking out of the other side of their mouth about normalizing their balance sheet. And we had this week FOMC notes come out where the Federal Reserve has put on notice that, well, maybe they're not going to do the normalization this year. The market was taking the message yesterday. We're recording today, Thursday, and on Wednesday, people were taking the message that maybe they will push it out into 2018, as opposed to as early as September 2017 being the consensus view of when normalization would begin to start. A tiny trickle of maybe some selling of their balance sheet bond assets of treasuries and mortgage-backed securities. This is all propaganda. And that, in the face of the dollar's downdraft, gold normally would be a lot higher, silver would be a lot higher. But we've had these bouts of massive manipulation. They're trying to target the flash crashes are perfect examples. They're wonderful looking glasses into how the market, in points of severe desperation, the bullion bankers in silver have been carrying this gigantic short position that, you can see in the COT reporting, you can see just generically in the open interest numbers, with silver being 16, 17 and change most of this year, and then crashing down to 15 handle a couple of times. And yet at the same time, we have all-time highs in open interest for silver. Excuse me? I mean, these things just don't compute, and it's a product of the massive amount of paper shorting that's been going on in silver in particular, but periodically in gold too, to keep this market under wraps.
And the dollar index is at 30-month lows. So not only has it fallen a lot, since January, we're at, definite bear market territory here with a 30-month low. But, you brought up 150 billion in credit injections per month by central banks. I think it's over 150 billion because Zero Hedge ran a story a month or two ago that central banks had already put 1.5 trillion in new money and credit into asset markets just in 2017. So it would have to be more than 150 billion a month. And, look at the balance sheets now of central banks. There was a Zero Hedge article. I have it up here. I'll put it in the info section. And now the Bank of Japan and the European Central Bank have larger balance sheets than the publicly stated balance sheet for the Federal Reserve's balance sheet, the first time ever that this has happened. So the European Central Bank, and this was June 2nd, 2017, so it's probably larger than this. The European Central Bank has 4.69 trillion on their balance sheet. The Bank of Japan has 4.47 trillion compared to the Fed's 4.4 trillion, which has been flat for a while. Now, obviously, Eric, we know that their public numbers on these balance sheets are not going to be accurate. They're not allowing independent financial audits. So we don't know, what the currency swaps or any other emergency liquidity injections they've had to do. But this is an enormous, over 18 trillion injection into asset markets. And that's why that's the main reason, I think, why we have Dow 21,000, why we have a, artificial bond bull market that seems to not want to enter bear market territory. And, yields basically just collapse. Yields that were exploding in Europe have now dissipated and gone negative to a certain extent. And so, whereas before the ECB started rapidly ramping up their QE programs, those yields were exploding in Spain and Italy, and now they're down tremendously. And the other major asset market besides stocks and bonds is the real estate market. And you sent me a chart before. There's a lot of cities now, Eric, in the United States where the real estate prices are higher than they were before the 2008 financial crisis, where real estate prices crashed.
Yeah, and we have real estate bubbles in many countries across the board too. And it's a product of all of this cheap credit leaking out into the marketplace, and loans being generated, and a lot of bad loans, and people not able to actually stand behind those kind of loans. And then we have the subprime problems and auto loans and all these bubbles that are being blown. And it's in aggregate, we have bubbles all over the place.
And it literally is the last title of our Welcome to Dystopia, Central Bankers Gone Wild. And so, they go in public and they give these speeches, but their behavior is the exact opposite of what they say in the speeches. Although, yesterday was the 5-year anniversary of European Central Bank President Mario Draghi's whatever it takes speech. So maybe then they do release nuggets of truth. It's just not all the time. Because, if you took him at his word then, they basically have done whatever it takes to maintain the status quo, to delay asset prices from crashing, to delay, the next global financial crisis as long as possible.
2011, 2012, it's easier to make those kind of proclamations to the market and have the market believe you, and then actually have the credit spreads with the junk Spanish and Italian and Portuguese and Greek bonds and whatnot being pushed down in yield, bid up in price because his ECB is vacuum cleaning up that garbage. But now we're in 2017, and the Italian banking system is still very, very shaky. And what are they going to do for an encore? I mean, they can't continue. Part of their buying was built on a percentage ratio formula where there would be ECB purchasing of garbage Italian bank securities, and then also banks, or rather bonds within the German market. They can't do it in the German market anymore because they're running out of bonds to buy. Well, they're crowding out and having a problem even from the mechanics point of view, the gears that are moving in this ECB creature that they've created to sop up the bad balance sheet debt of banks in Italy and other weaker countries. So that the whole program is just rotten to the core, and the Italian banking system still sucks. I mean, what are they going to do for an encore? They've already done whatever it takes, and it didn't work.
Well, they've delayed, the euro currency collapsing. They've delayed the European Union collapsing. So, for these myopic, short-term oriented, rent-seeking, parasitical central planners, bureaucrats in Brussels, Keynesian central bankers, academics who believe in Keynesian economics, that's a good thing. That they, because I did a short little video yesterday, and I showed mainstream media articles saying how Mario Draghi saved the euro with that speech, and by the European Central Bank's QE programs. Well, they didn't save the euro; they delayed the collapse of the euro. And look at the cost that was required to do it. The European Central Bank's balance sheet now is much larger than the Federal Reserve's balance sheet. And the European Central Bank wasn't supposed to be able to create money out of thin air and buy any of these things. I remember years ago when I first got into financial markets, people saying how the European Central Bank wasn't going to be allowed to do any of these programs that the Federal Reserve was going to be allowed to do. Well, the rules were changed. Surprise, surprise, right? So, it's just funny that we have the hubris of people like Janet Yellen coming out recently and telling the person interviewing her and the audience that there will not be another financial crisis in our lifetime.
Yeah, well, she actually said in her lifetime, the ultimate hedge there, older woman that she is, amusing as that is. But, I mean, in the United States, let's bring it to U.S. context, what we just described with the ECB dynamics. The Federal Reserve used to, before the financial crisis in 2008, only had $25 billion worth of bank-held assets in the Fed's account held on behalf of banks. When the Fed started buying treasuries and mortgage-backed securities off of these banks, and in particular the mortgage-backed securities, maybe, valued at anywhere from like 10 cents to 30 cents on the dollar, and the Fed's buying this garbage at 100% par value. The Fed ballooned from $25 billion to $2.4 trillion as of July. And all of this garbage can't be sold in the marketplace at face value. What are they going to do? I mean, this whole game that they're playing about trying to normalize their balance sheet and claim that they're going to do some significant cleaning up of their balance sheet is a fiction. The stuff that they bought was garbage to begin with, heavily, discounted. If it were to go onto the public market when all of the shit was hitting the fan back in 2008 through 2010, it would have been pennies on the dollar.
I think there's just enormous coordination behind the scenes, like Dr. Mark Faber and others have said, with respect to all these major global central banks in Bank of Japan, Bank of England, European Central Bank, the Federal Reserve, and maybe even China is coordinating behind the scenes with all these guys.
Yeah. I mean, the real estate market did get reflated. I mean, there's no doubt about that. So when I make the point about 30 cents on the dollar mortgage-backed securities, obviously they'd get more at this point because the market was reflated. But it's still garbage assets that they bought at par value that, maybe on average is 85 cents on the dollar compared to what they picked up. That's a huge amount of money to be carrying on the behalf. It's a direct subsidy to the banks because the Fed bought that stuff at par value. And that's what has sustained the bank. And isn't it interesting, too? I mean, today, as we record on the 27th of July, after yesterday's jump higher with all the algos reacting with kumbaya anticipation of the Federal Reserve delaying their normalization of balance sheet from the minutes that they released, S&P 500 goes up a bit, even gold catches a bid because people are breathing a sigh of relief. I mean, that's not a contradiction. You can actually see both of them reacting that way, punch bowl being there for the equity market. And what do we see today? S&P 500 going down, and the banks are going down 3 times as much in percentage terms. At some point you got to wonder whether or not the algos and the automatic buying and the brainless buying by hedge funds and, money managers just doing momentum yesterday is being replaced by a small whiff of rationality today. I mean, our fundamentals are just not there. This market is running on fumes, and as we were talking about a moment ago, the central bank continuing to put in tens and hundreds of billions of dollars, rather, of funds into the market every damn month.
And the market may be running on fumes, but I think President Trump is playing an extremely dangerous game of, saying how taking credit for Dow 21,000. I think that's not a smart move on his part. And, the other thing is he's claiming all these millions of jobs were created. When before he won the election and he was campaigning, he was I think correctly, saying how the central banks were manipulating asset prices, they were manipulating interest rates down, the jobs numbers were not correct. He has mentioned in speeches over the last couple months that the jobs numbers are not right, but then why is he also claiming credit for when the jobs numbers are good? So he's sending out, contradictory signals. But, basically, Eric, I think with his ego and his hubris to want to proclaim how good he is and how smart he is and talented he is at stuff, he's made himself essentially the perfect bag holder that these, the deep state and the central bankers and all the people who hate him can blame him now when things do crash.
Yeah, and you got to wonder what's going on with that because he does understand that the market is valued by bubble economics. I mean, clearly he knows that.
And the thing is with these central banks, especially the Federal Reserve, claiming that they can reduce their balance sheet if they are coordinating, and I think there's a lot of evidence that they are. We know that they meet at the Bank of International Settlements, and that there's at least monthly conference calls. I've seen schedules printed out from the Federal Reserve saying, conference call with ECB, conference call with Bank of Japan. I've seen actual pictures of the itinerary with the schedules on there. So we know that they're at least talking and discussing things, at least some of the things. So if the Federal Reserve does, maybe reduce their balance sheet by $100 billion, but let's say either the European Central Bank or the Bank of Japan starts bailing out, banks that have these assets or buying up other assets or not reducing their QE program, then is it really a meaningful balance sheet reduction? So it's not then. I would contend that it's not if they're coordinating and, they do one thing with one hand and another hand is, filling the thing back up with even more money and liquidity.
Yeah, and we see those kind of games even when they're talking about how they, change the federal funds rate, the interest rate. I mean, it's not a direct translation even when they do hikes. Ultimately, the Federal Reserve's balance sheet normalization process is probably going to just default to letting maturing positions, maturing bonds, go off their books just because they're not, and possibly not reinvesting interest that comes by them not buying, new positions with the interest. That kind of whittling away process of trying to, at the margin, reduce their balance sheet is something that would take them, 30 years or whatever, more, to make a significant material change in the balance sheet. And we know, anyone who looks at like a, 40-year chart of the national debt and 40-year chart of where Federal Reserve's balance sheet has been in relation to that and credit issuance and whatnot, that's not going to work. We're going to have financial crashes, multiple crashes, and in that period of time. And how has the Keynesian paradigm dealt with that? Well, they just reflate after another crash. So where are they going to reflate from this time if they're trying to sell the smoke and mirrors BS about normalizing their balance sheet?
Yeah,
This
is kind of, how a magician does his trick. He needs to either tell someone in the audience the trick he's going to do so they can help him, or he has assistants, people he's handpicked out in the crowd already that he's planted out there, help him do the trick. So this is a central bank shell game. I mean, I want to give an example of this. So about 3 weeks ago, the Bank of Japan said it will buy every single 10-year Japanese government bond in existence, and that they will print up however many Japanese yen it takes to buy them, to prevent, their bond market from collapsing. And the Japanese yen against the dollar, it didn't even really move when they issued the statement in public.
Mm-hmm. Yep.
Well,
and even that, I mean, they've already been doing nearly that anyway. I mean, there have been times when they have maxed out available bonds to purchase, and a couple of times in the last couple of years, sucked up all of the bonds that are floating around.
Exactly, and some of the days I think now bonds don't even trade because there's no market for them anymore because there's no demand and there's very little supply because the Bank of Japan has been buying everything.
Yeah, and the percentage of ETFs they hold and the percentage of stocks across the board they hold in their equity market is super high. I mean, it's surreal. They have actually been able to get a tiny blip of economic improvement after multiple decades of this nonsense. People are now getting excited about that, but their economy is rotten to the core, and then they have this demographic time bomb that they're dealing with as well too. It's a mess.
And their central bank also owns a large amount of Japanese ETFs, and they're becoming large holders of U.S. stocks, kind of like how the Swiss National Bank, their central bank, is now with their hedge fund portfolio of U.S. technology stocks. I think the Swiss Central Bank owns $80 billion in U.S. technology stocks. I think they're the largest shareholder of Facebook at 4 million shares. They own a lot of the FANG stocks. I mean, these central banks they're fooling. Okay, so if you don't look at any of the fundamentals, if you're just a chart guy, Eric, so you don't read any stories on Zero Hedge, you don't look at any financial statements or balance sheets or anything like that. If you just looked at the charts and you're a technical guy and you didn't care who bought the shares, you would say that the stocks, I'm hearing from regular technical analyst guys, that they think that there's a brand new bull market in stocks at Dow 21,000 and that it's going to keep going a lot higher. But these guys, don't look at any of the central bank purchases and how ridiculous we've gotten, theater of the absurd territory.
Yep, and isn't it interesting that the day after we get the FOMC minutes and the S&P 500 hits a brand new high, and then all of a sudden it's falling back down. Where's the momentum there? The momentum today dried up. The futures markets dried up. The FANG stocks took a bath and they dived down. I mean, this whole shift in psychology I find fascinating. Immediately following the party that the algorithm-based traders and the systems, the computer-based trading executed after the FOMC minutes. I mean, at some point, reality's got to come in to picture. The FANG stocks were the generals of the market for like 2 years. The irrational hedge fund chasing of momentum was there. The, copycat money managers trying to make sure that they didn't lose their job by not being exposed to the momentum rise of FANGs and other similar sectors. And then all of a sudden, the FANGs started rolling over 2 months ago. Well, that's a pretty significant change in the dynamics that are going on in the marketplace, and I think that's telegraphing where the overall market is going to be a couple months further out.
There was also a lot of money that came from passive investing into index funds, and a lot of these indiscriminate buying from index funds bought a lot of the FANG stocks for their indices. Yeah. So the money was not distributed evenly. If you look at, the earnings reports for non-FANG stocks, a lot of these companies are doing very, very badly. Their shares are down quite a lot. So it's really been the FANG stocks that have been dragging a lot of these indices much, much higher. Because if you looked at, a wider breadth of different companies, total advances versus total declines, there's been a lot more companies declining with bad revenue misses, bad earnings, and share prices down lately than companies that are beating earnings, boosting guidance, more free cash flow, revenue growth, earnings growth, etc.
Right.
So, normally in a bull market, Eric, in a natural bull market, what you would see is more advances versus declines of total companies, and you would see companies then that were either have pricing power, improved fundamentals maybe in an industry or something. But now with the market manipulations and Wall Street bubble financing, especially with the shale stuff, that basically I did an interview with Art Berman a couple weeks ago, the oil guy, and he actually drills wells in addition to being an oil analyst. And he agreed with me that a lot of these U.S. shale oil companies are essentially being financed exactly the same way that technology stocks were. Revenue growth only, free cash flow doesn't matter, profits don't matter. As long as the company anyhow can continue to grow revenue, Wall Street and the financiers can continue to get them more equity raises and or cheap debt. Or at least that's been the case for the last couple years. I think now, Eric, there's some evidence that things are starting to slow down. That may be a good shorting opportunity in the shale, because if oil does have a rally, there could be more supply coming online in the near future, which could, put even more pressure on the price.
Yeah, and we're seeing very significant companies begin to change their behavior in the marketplace with their CapEx expectations going forward. I mean, Anadarko Petroleum is pulling in their horns. Halliburton this week has also said that there's a noticeable slowdown in the shale patch. So there's something going on here. The expectation for possibly weaker oil as well is maybe impacting the decisions managers are having in major independent shale patch producers. But the financing, compared to the actual cost, the real cost versus what they are reporting, is part of it too. And the economy overall is a fiction. People are building in expectations that now are coming home to roost that are clearly not what people thought was going to happen by now. We've seen the credit cycle in China turn down massively last year. Around September or so, they began to rein in credit and try to go after their large guests and problems within the shadow banking system in China. And, the whole Trump expectation of deregulation and tax cuts and infrastructure spend resulting in a giant boom in the United States. We should have already seen some of that by now based on the expectations that came with the day after his election in November, and people thinking, oh boy, we're going to have $1 trillion infrastructure spend, never mind the fact that that was a fantasy from day one. All of that expectation of economic activity is now beginning to be seen as nothing but a fantasy. And that's going to weigh on the oil market. The whole expectation of the Trump impact to the U.S. economic backdrop has gone up in smoke. I mean, when he was elected, the very next day, people were building in expectations of tax cuts, deregulation, infrastructure spend anywhere from $500 to $1 trillion. I mean, all of that whole major wave that helped push the S&P 500 up 10% within a matter of a couple of months has gone up in smoke with the political partisan insanity that we have in the United States, combined with the ill-thought-out plan to begin with from Trump. I mean, there was no way of raising that kind of money for infrastructure spend to begin with. So, I mean, that has a direct impact on going forward economic activity as it translates into oil demand. So the shale producers are probably darn nervous, and rightfully so, about being able to continue this bubble financing game indefinitely, and it has been a bubble financing game.
Yeah, and there's a good interview with a really well-respected, good track record short seller on Real Vision TV in the last week or so, and the guy said the one area he's looking at now that no short has really gone into yet that he thinks is going to be extremely profitable on the short side is the U.S. shale oil drillers. So, they've been able to keep growing revenue, have really extremely large access to capital, and he thinks, those hedges are going to come off the balance sheets. People are going to start looking at the balance sheets in the near future, and if the oil price drops, the shale guys, once those hedges come off, are going to be in major, major trouble. The other thing is that they were getting discounts to drill. So the service companies like Schlumberger and Halliburton and those guys, they needed the cash flow too. So they were offering 15-20% discounts to shale oil drillers to complete wells. So once those costs go back up, any margin they had and they weren't generating any free cash flow, they're going to be in even worse trouble. But yeah, I think you talked about the credit cycle. I think there's a lot of evidence all over the global economy, except for asset markets, Eric, that in the real economy, businesses associated with that there is credit cycle tightening. That we are starting to see a super saturation of credit in a lot of different markets, whether it's subprime auto, enormous non-performing loans in the Chinese economy across the board. I've heard estimates of 90% or more non-performing loans. I've heard Banco Santander from hedge fund managers is in trouble with their subprime auto loan book. I'm not sure the exact numbers there, but I think the share buybacks from large corporations with debt to boost their stock and goose earnings. Not real earnings growth, but doing artificial growth to trigger stock options. I think even that amount, that was an enormous amount market that Wall Street investment banks were profiting from. I think that's even down 25-30% in the last 18 months.
Yeah.
Of using share buybacks.
The buybacks between 2010 and 2014 were absolutely gigantic. It was like 1.3 trillion or whatever.
Yeah.
And that was all because of the low interest rate paradigm.
Yes, and Wall Street banks were getting a lot of fees on those, and there were a lot of short-term parasitical rent-seeking incentives that I mentioned there. But that has even started to slow. So there has been a lot of leverage buyouts with debt too, because Wall Street makes a lot of fees on those on leverage buyouts that investment banks do. But there's a lot of signs that a lot of these markets that have used a lot of credit since the 2008 financial crisis, that the demand for credit in those markets is slowing. So, basically then the only thing pumping, credit, money, easy money and credit into the market still is the central banks, which people, if you would have told me in 2008 or 9 that the Federal Reserve, their balance sheet would expand like this, all the central banks I would have said, no way. they would have potentially hyperinflated the currencies, but they've managed to trick a lot of people with basically stagflation in the real economy and higher asset prices that, things are not as bad as they seem.
Yeah, and you can also add on top of that the consumer economy, and particularly more so in other countries like Canada and Australia. I mean, the individual consumer's debt level has just gone berserk, and right along with the kind of credit that's being ushered in by the central bankers, and that ends up being a marker of the top of the credit cycle, where people are just too darn extended and they can't get extended any further. And individuals, unlike the central bankers, don't have printing presses, metaphorically speaking.
Exactly. I completely, totally agree. I was in Toronto in September of 2016 and going to a Sprott event, and in my hotel room on Business News Network, which is their main business channel, they were running every 5 minutes commercials for home equity loans and second mortgages. I was in shock how often the commercials were running. Yeah. And, what we've seen with the real estate bubble in Toronto and Vancouver, and I think, Canadians have enormous amounts of debt with credit card debt and second mortgages on their homes. I mean, this is getting to U.S. levels, if not worse.
Oh, it's much worse than U.S. and in Australia, it's 3 times as worse as Canada. I mean, the bubble in real estate there is huge, and we're talking like 260% per capita debt exposure. I mean, relative to GDP, individuals being that overextended. The aggregate debt in the consumer space in Australia is that high relative to GDP. I mean, the people are completely extended and overextended, and they can't get away from that with wages declining at the same time.
And yet we have a big copper rally in the last couple of days. We've had a big copper rally, and people are talking about a copper bull market restarting. I don't see any evidence the global economy is doing well. I don't see a lot of demand increasing for copper. People are saying, these electric cars, that's what's going to create the new demand. China was the copper market. China was about 50% of the copper market. They pulled, in my estimates, at least 4 decades of demand forward into only about 15 years of copper demand. And that demand, since China has already built so many infrastructure, cities, etc., that demand has slowed a lot. So I don't think, I think it's just a bear market rally in copper, or there's manipulation involved maybe to move the copper price higher, so the banks don't have to start calling in bankruptcies and bad loans on the copper miners and base metal miners then.
Right, and there's some expectation that China is not going to be as aggressive as they were earlier this year and last year in terms of reining in their shadow banking system. But that's a fiction. They're on balance contracting their shadow banking system, and that's part of the reason why copper went down in the first place. Why we had this huge hit to iron ore as well. I mean, base metals were hit pretty hard when China was doing this earlier. So.
Well, I think copper and the base metals were, they had gone way too high, way too quickly, and people thought it was easy money because of China and that the Chinese demand would, last many decades more. But so much demand had been pulled forward already. I think we were in a situation a few years ago where there was a huge oversupply of very high-cost mines that were being built for, copper and iron ore and base metals, and the demand had started to shrink. So I don't think enough of these guys have gone bankrupt yet. Unlike a lot of the gold and silver miners, a lot of these copper guys did hedge, so they locked in their higher copper price at a profit for years in advance. Not sure what their hedge books are now, but they've delayed bankruptcy a good amount because of that. But the gold and silver miners didn't do that, so they're in a lot worse shape. Actually, before we wrap up the show, Eric, and talk about the rest of the gold and silver market for the rest of the episode, I just want to ask you about your opinion on why you think China and Saudi Arabia, after years and years of reducing their treasury holdings, getting out, have started to buy a lot of treasuries again in 2017. Do you think it's because of President Trump shaming them into buying it?
Well, I mean, there's a certain level of political strategizing and currying favor that come back and forth, and in particular with China, there's been a warming of relations with China and Trump, and then it fades, and we've gone through 3 cycles of that since Trump has been in office. So, the Chinese central bank and the political authorities there do appreciate the political sensitivities of how to work with the Fed and how to work with the overall credit system and how they manage their shadow banking system and the yuan outflows that were coming out of their system and how they go about buying U.S. treasuries in relation to that. They do a lot of, convoluted moves that on a periodic basis have them buying treasuries. I mean, this is not something new. It's happened before. In the last 5 years, we've seen periods where they will suddenly come back into the market and buy treasuries after, trying to reduce their dollar exposure. So I think that's part of it. And it's really opaque, and it's hard to figure out exactly how all of those moving parts fit together when they have bouts of capital flight coming out of their markets. I mean, we've, in this year, seen a couple of periods of a number of weeks where there have been huge movements out of their markets, and they're trying to shut that down. When they make war on the shadow banking system, what happens is you get a lot of capital flight. And so, part of what's going on, I do believe it's political, and it also hooks up to how they deal with their shadow banking system, and they're trying to globalize their financial footprint, their markets being more bigger and stable as they try to grow them and become more of a force on the international stage. But they also don't want to have huge U.S. dollar exposure, so they continue to do what they do with hedging with gold. They continue to try to buttress their financial system so as to be able to, in the long run, over a number of years, be able to have the yuan serve as a parallel reserve currency asset within the banking system in the West, with more banks holding them. The SDR strategy that they executed to become part of the SDR basket is part of this picture. So they do this political dance with the United States where they try to gain their independence, but at the same time curry favor with the United States Treasury and be a good soldier and pat the United States on the head and purchase bonds from us.
Yeah, because I remember when Trump was campaigning, and then when he won, he was talking about labeling China a currency manipulator. Well, maybe, China said, if we buy some treasuries here, start buying them again, will you, stop with this rhetoric? Will you stop with this rhetoric about, labeling us a currency manipulator, putting tariffs on our goods?
Right.
And obviously, we know the Saudi Arabia has started buying treasuries again, too.
And
we know,
look at when they did that. It was after the $300 billion defense deal. I mean, that's like an echo of the original Kissinger petrodollar playbook from the 70s, where the United States provisions the security of the royal family from being overthrown because it's, tin pot dictatorship in all intent and purposes. And they, 14,000 members of the royal family sitting on top of the entire country is this ridiculous oligarchy, and it's a very unstable country, and they would not be where they are were it not for basically Uncle Sam being the guarantor and backstop of the Saudi Arabian royal family and the entire political system that sits under them. So Saudi Arabia had every incentive in the world once they, are receiving all of the benefits of this ongoing relationship, and they recycle their economic gains into U.S. treasuries from time to time. That's been going on since the 70s.
Yeah, and the other thing is, maybe they also didn't want any more of the 9/11 Commission stuff that Congress released. Remember, a lot of that stuff was redacted, but it showed Saudi Arabia's name. Maybe there was more information that was going to come out, and that shamed them into buying more treasuries. But I mean, Saudi Arabia has been taking on a bunch of debt lately just to pay off their social programs. They still want to IPO Saudi Aramco in the near future at a ridiculously high valuation. I would not buy that. I definitely would not buy that. But the investment banks may prop that up to make it a high share price with manipulation. So it does well initially. But yeah, the gold and silver markets right now. My view of things. You mentioned China and demand for physical gold. The numbers we see, Shanghai Gold Exchange in India, for physical gold and silver, the numbers are very strong out of China and India for a demand for gold and silver. It is in the United States, especially with U.S. retail investor demand, where where demand for gold, silver, and mining shares has totally collapsed. Sentiment, in my opinion, Eric, I think it's as bad as it was in 2015. I think it might even be worse.
Yeah, I would say it's worse. I'd say it's as on par with as low as it's ever been, skirting along that bottom of sentiment.
But
and yet, at the same time, we're actually still doing, all things considered, reasonably well. Gold with, $1,240 handle on it in U.S. dollar terms. I mean, that's not too bad. I mean, if the powers that be were able to execute what they would wish to see gold trading at, we'd have 1,100 handle easy. Well, and every time we go through these flash crashes, and every time we go through these periods of intense manipulation when gold gets pushed down and silver in turn, sometimes silver being attacked first to paint the tape and impact sentiment on gold, we always bounce back. And that's because the physical market overall is a lot more healthy than anyone wants to give credence to, other than people who pay really close attention and don't have their head lodged in the mainstream media's arse.
The mining shares are also attacked too first to try to weaken gold and silver prices as well. That's been a common tactic as well. But you mentioned if gold had gone to those prices, if gold was at 1,100 or lower, if silver had gone to $15 an ounce or lower. I did a short video on this. I think there was going to be at least, if silver had gotten to 15 or lower, there was going to be at least 30 million ounces of silver production, annual silver production that was in jeopardy of being extremely uneconomic, and or the producers of that silver were in dire financial problems.
Yeah.
So, and that number would expand even rapidly the lower silver went. For every 50 cents or $1 silver went below 15, it would get worse and worse and worse in terms of the ability of the producers. With gold, I think we're at a price now where the miners can essentially tread water. They won't go out of business yet, but they can't exactly replace reserves or grow production. So it's kind of, the industry's treading water. Maybe some of the miners that are lower cost are making a couple dollar, if they're silver, making a couple dollars an ounce in decent margin. In gold, maybe they're making $100 or more an ounce, but the majority of those mines are not like that. In general, Eric, from my research now into the silver industry, I think the last couple years, a lot of the larger primary silver miners are leaving the silver business. They've been adding a lot of primary gold production into their asset mix, and I think it's a combination of things. I think the economics of a lot of gold mines, there's just a lot more profitable gold mines available than profitable silver mines, and there's just a lot of uneconomic silver projects available now. So that's why you're not seeing a lot of new silver mines being built. There's a lot of silver mines right now that are in production that have a very high percentage of base metals as their revenue mix, that are, without accounting of byproduct taxes, are not really primary silver mines. So in general, if the silver price doesn't go to $25, I think 25 is going to have to be I've said this for a while now, we're going to have to see 25 to 30 silver in 2 or 3 years, and that's going to be the minimum price for silver miners to replace reserves and start growing production again. Otherwise, you're going to see a lot of the miners like Hecla, Silver Standard, Coeur d'Alene. Silver Wheaton doesn't actually mine silver, but they finance silver mines and base metal mines with silver byproduct. They've stopped doing a lot of silver deals and been focusing on gold. You're going to see more of that.
Yeah, and when you have an economic situation and fundamentals in the industry that over a 3-5 year window, you can conceivably have upwards of 15% of supply come off the market. All markets are based on at the margin pricing. That kind of a reduction in supply would just be devastating to the ability of the manipulators to control the price. The physical market is ultimately going to prevent this manipulation from making prices much lower at least, from where they are now. We've never been able to get it below 14, even though they beat the living snot out of silver in particular, as witness the open interest numbers on the COMEX. That's the one area where people can look at very easily. I mean, we have no idea what the heck's going on in the OTC market, which is an order of magnitude even larger than what COMEX is and the LBMA is. But the manipulation is just out of control. It's so bad that it's going to end up bankrupting a lot of miners if it continues on.
Yeah, exactly. So I think, we're going to have to see $1,400, $1,500 gold probably 2 or 3 years. We're going to have to see $25, $30 silver in the next 2 or 3 years. If we don't, the industry is going to struggle to maintain the current production levels, and you're going to start to see production decrease.
And that has nothing. And to say that has nothing to do with the backdrop of our economy, nor condition of financial markets and investment demand seeking refuge in the face of a credit bubble. I mean, this is just basic industry dynamics where if you have a hit of 10 to 15% supply reduction in silver over a 3 to 5 year period, that's gonna make it impossible to have these kind of games that are being played, where they have exchange traded, forward swaps on the LBMA hooking up to the OTC market, provisioning the ability to meet demand calls and cash settling through the back door on all of these paper contracts of longs that go into the silver market. That's how this game is being sustained. And in the gold market, too, it's part of the manipulation game that's going on. That kind of willing participants to play that Ponzi game will go out the window when we have a huge reduction in the actual physical supply and some company like Sony steps up to the plate, and because they have a certain amount of demand that they have to fulfill to produce the products that they sell in the marketplace, and it being at a per product basis a tiny expense in terms of how much silver goes into any of their electronic products. I mean, those are the kind of things that change marketplaces. We actually saw that in the last couple of months in palladium. The demand for palladium and the physical market shifted because of the shift primarily with Volkswagen not selling as many diesel-based engines in their automobile fleet. Then that put a bid under palladium in the long run, and it took about a year and a half for that to kind of translate through the marketplace. Then all of a sudden people are like, hey, what's going on with the palladium market? Why is it going up as much as it is? And that is a reflection of the physical market asserting itself through the paper Ponzi.
Yeah, there's a 16% lease rate on the LBMA for palladium.
Yeah.
We haven't had that in silver yet, but who knows what's going to happen in the future. But before I let you go, we got 2 more things to cover very quickly. Your opinion on the comments of the CME Group CEO about, he said that $5,000 or $6,000 gold should be a no-brainer.
Yeah, I know some people are speculating that perhaps that's like a limited hangout to say, oh, well, we warned you that the market was manipulated, and that in an after effect it kind of gives them some kind of a insulation after things blow up. I don't know if I would subscribe to that notion. I think that just from a basic understanding of economics, some of these people have been in the business long enough to know, any CEO. Jamie Dimon, let's face it, someone like a Jamie Dimon damn well knows that he's sitting on top of financial markets that have been financialized and blown into bubbles that have lifted all assets, and that is the basis of where we are. And if you understand that, you don't necessarily have to have chapter and verse understanding of the mechanics of how gold and silver have been suppressed as part of the control grid that enables the bubble to exist, to simultaneously understand that were the bubble not to exist, and that if there wasn't, this kind of artificial nature of an economy based on artificial credit, that obviously gold and silver would have to be a lot higher. And at base, I think we can conclude that is the guy's understanding, and he was just speaking to that. Maybe there is another element of conspiratorial thinking as well, but we don't even have to go there. The reality is that these people understand that the system that we're living in is artificial. They know that. People at the very top of the money center banks know that. They were the ones who received $2.5 trillion of vacuuming, fluffing from the Fed and removal from their own banks, the balance sheets of their own banks, the crap that they, over the course of 4 years in the real estate bubble, sold into the market with securitized products. I mean, they created it. It was theirs. They saw it, so they know that the bubble existed, and it was an artificial reflation of the assets. So seeing that artificial reality and then off the cuff commenting about what's going on with gold and silver relative to the overall system is not a huge surprise. But it's a surprise that he was that honest, for sure. You got to wonder what the heck he was thinking to say something like that in public. Certainly raised my eyebrows.
Yeah, I wonder if the question was planted or not. Yeah, I'd want to know, because normally with CEOs of companies at large, they want to know like the questions ahead of time.
Right, yeah.
That they're going to be asked. So I'm wondering if he knew that question was coming ahead of time.
Yeah, maybe.
But, Andrew, I like Andrew Maguire. I've spoken with him in emails, but I mean, Andrew, you got to stop sticking your neck out and making, crazy price predictions and hyperbole. Maybe this bullion coin is a good idea, but, saying it's going to stop the manipulation with a 250 ton physical gold purchase of a cryptocurrency backed by bullion from a sovereign order. Come on, man. 26 days. Come on. It's ridiculous. I mean,
that kind of bullion wouldn't even be available. So even if a sovereign wanted to buy it, it doesn't exist. So prima facie analysis of his claim just kind of leads one to realize that it's impossible. So, and when he first started talking about that kind of stuff on King World and News, he wasn't, revealing his entire thesis. He didn't speak about it being linked to a cryptocurrency purchase from a sovereign trying to do this parallel currency or whatever. The only time we've ever seen large sovereigns act in the marketplace with free ability to so-called purchase large tonnage has been when they're going after something like an IMF offer. Back in, I think it was 2011, the IMF brought to market 400 metric tons. Initially, China expressed interest in it, and China was told to go pound sand, and then India was the one that took on that, and it probably was just, a post-it note, movement within the, IMF inventory held by the, Federal Reserve Bank of New York depository and other places and whatnot. I mean, it wasn't actually even, physical gold moving around. Where the heck is a sovereign going to find 250 metric tons of gold in a 26-day window? That's impossible.
And where 100% of the annual gold mining supply is bought, more than 100% now, by mainland China, not the Chinese government, from the Shanghai Gold Exchange in India. So all the gold that's produced by miners each year is already spoken for.
Yeah.
And so normally with central banks, Eric, they don't advertise any of their purchases. It's normally when they're going to sell is when they advertise it in public. Oh, we're going to...
And only Venezuela, when they're seeking to bomb the market, and the infamous Brown's bottom is a prime example. Because they're purposely trying to bomb the market by selling. And they're not even doing that now. The central bankers on balance are net buyers. And they've...
Yes, and
they have formal agreements to not sell.
And I've heard stories from people with good contacts of, central banks and governments doing large purchases of physical gold, but they didn't do a press release. It was, the purchases were done discreetly.
Yeah.
So, I do like Andrew Maguire. I think he's a smart guy. I don't know, maybe he's getting caught in the King World News hyperbole, pump job hype bubble. I don't know. But he needs to stop sticking his neck out there with crazy price predictions and hyperbole and some of the other stuff.
Yeah.
And just stick to what he does well is, he talks about what's going on in the market with the hedging, with the miners, and how the bullion banks force them to do certain hedges in the past. That stuff he's good with. He should not, make crazy predictions like that and stick his neck out, though, saying, that order is going to totally change things. I mean, even if that much metal, Eric, could actually be acquired, with the paper price market, I mean, it wouldn't permanently keep the price high. the demand would have to be sustained for physical metal. It wouldn't, a one-off order that large would not keep the price with the paper markets the way they are that high. There would have to be sustained increase in physical metal.
I would disagree with that if it was even possible to do a real physical market purchase that big. I mean, that would at the margin create a huge wake in the physical market buying. Witness what happened in 2013 after the April drive-by shooting when, you know, India and China were taking down hundreds of metric tons in the next couple of months, and that did change the marketplace. So, you know, I mean, it's neither here nor there because that kind of gold doesn't exist. Not freely available, not real gold.
Well, fair enough. Until you know, this is probably a contrarian indicator because we're seeing, you know, extreme bearish sentiment both from the miners and from, you know, U.S. retail investor demand. So I think, you know, with those things, that there's a good argument to be made that we are putting in a bottom with sentiment and the other fundamentals of the market. Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.